Hey, Jim. Thanks for joining me. So you're on the wines, which is good. I'm on the water, but it is what,
Yeah,
9
okay,
a.m.
cheers.
over in Australia. You said in one of your recent tweets that you spent the lockdown in the mountains. Then you moved to the city for July, but you're by the beach now.
Right.
Yeah, so it's good weather over there. I take it.
That's right. Of course, our seasons are reversed in Australia. It's the middle of summer here. In fact, it's August, which is a big vacation month. But I'm enjoying the beach house with family members and company and so forth. So it's a great time. Yeah, the weather's very good. Thank you.
Cool. Well, I wouldn't mind swapping places because actually you probably know Melbourne's in strict stage 4 lockdown.
Right.
So I'm hoping it's not going to last too long. But it's kind of like you said in your recent issue of in your latest issue of Strategic Intelligence, and that is that you pretty much had the year mapped out in January, and you kind of figured it was all going to be about the election.
Right.
And then something comes in like the virus, which completely throws it to whack. So perhaps I was thinking maybe now that it's August, where do you think, what is the story for the next few months of the year? Do you think it's swinging back to the election now primarily?
Yeah. First of all, Woody, by the way, I've been to Melbourne a number of times. I have a number of good friends there, starting with you and your colleagues. So I'm very attentive to what's going on in Melbourne and wish everyone well. So I know it's a tough situation. That was certainly what we've been through in New York City and the surrounding areas. We've seen the worst of it. So, hopefully this will all go very well in Melbourne, but I'm certainly thinking of you guys. I'm a bit of addict is the right word, but I use the Johns Hopkins dashboard. I'm sure everyone in the world is using the same resource, but I probably log on 5 times a day. But it's not just for the snapshot, it's for the trends. I've just written a new book on this. It's coming out at the end of October. It should be the first book on COVID-19, the COVID-19 pandemic. But more to the point, it covers the pandemic and the medicine associated with it, but also the economic depression, with a forecast for the future and recommendations for what investors should do. It's called the New Great Depression, Winners and Losers in the Post-Pandemic World. But the point is, in kind of doing the research for that book, I had to do a deep dive. I was completely at ease with the economics side of it, but I'm not a doctor. Let's just start there. Then people say, well, Jim, you're not a doctor. Why should you be writing anything about epidemiology or virology or immunology? And my answer is, the immunologists have been put in charge of the world's largest economy, the United States. So don't be surprised if economists weigh in a little bit on the medicine because, turnabout is fair play. So, but I did quite a bit of research associated with that. I guess the bottom line, Woody, is this is not going away soon. When I say this, I mean the pandemic, the virus. There's been a lot of talk. I'm sure it's the case in Melbourne, but definitely the case in the United States, California in particular, about what they call a second wave. What they mean by that is the virus struck some time ago, kind of in March or April, as it did around the world once it got out of China. Seemed to die down, seemed to run its course, seemed to be under control, not completely, but really good progress. And then boom, there's a very large outbreak, and people immediately say, well, here's the second wave. And I make the point, this is not a true second wave. Second wave, and the term goes back at least to the Spanish flu of 1918, is when it hits hard, sadly, a lot of fatalities, and then it almost goes away. It just seems to be not just under control, but very much contained, very much run its course. Some time goes by, it could be 3 months or 6 months, and then it comes back a second time in a mutated form, far, far worse. That's a real second wave. What we're seeing are actually, it's a continuation of the first wave in terms of the virus itself, with timing differences and location differences. Just to kind of put a finer point on it, this originated in Wuhan, China, so that's easy. We know that. Whether it came from a lab or came from the wet market, I spent an enormous amount of time researching this, drilled down using some techniques I learned in the intelligence community. I lean in favor of the laboratory. It's not a bioweapon. It wasn't really purpose. It was released by accident, but that laboratory was doing experimental work on the bat coronaviruses. So it got out of there. But putting that debate to one side, it spread around the world. And what happened was the Wuhan virus went to the west coast of the United States, and I dare say Australia. because the Chinese didn't take the proper precautions. Not only precautions, I would say they were criminally reckless, negligent in terms of allowing so many of their citizens to go abroad. So it hit the West Coast, it hit Australia, and it hit Europe. That was the original virus. But when it got to Italy, it mutated, went through its first mutation. And epidemiologists call this the Italian strain. The Italian strain then came to New York. So what New York got hit with, and you have 25,000 dead in New York and another 20,000 in nearby communities in Connecticut and New Jersey. Those, almost 40,000 dead, about a third of all the fatalities in the United States, they got hit with the Italian strain. Of course, Italy suffered very badly, and the UK suffered very badly from that. Now, so you go back to April, let's say, you're looking at New York and California. Sorry to be so geocentric, but I'm more familiar with the U.S. data, and Melbourne for that matter. It looked like Governor Newsom in California was doing everything right, and Governor Cuomo in New York was doing everything wrong, based on the fatality count. But what that ignored is that they were fighting two slightly different diseases. It's all coronavirus. It's all from the same source, but really two variations of the same disease. And I'm not faulting, I will fault Governor Cuomo in some ways. I'm not really taking anything away from Governor Newsom, but the fact is they were fighting two diseases. Now, in due course, what has happened is that Italian strain has spread from New York to Florida to California and around the world. And I expect that this is what Melbourne is dealing with right now. So it's not really the second wave as epidemiologists understand it. It's really a delayed version of what hit New York in March, and it's bad. It's actually, it's not more fatal, but it is more contagious. Well, of course, that means you get more fatalities, but it's not more of a killer virus, but it spreads more easily, and that's the problem. So this is a long-winded answer to a very precise question, but I would not expect this is going away soon. I would expect that this will get worse in Melbourne. It'll get worse in California. New York may be past, well, obviously New York is past the worst of it. They had the as I say, the more contagious form of the disease. It may have a long way to go. And so, and of course, the depression, the global economic depression has come out of it. Notice I don't use the word recession. I use the word depression, which has a different meaning. It's clearly worse, more long-lasting, and I think it will have intergenerational effects. As I've studied it, we're going to feel the effects of this for 30 years, not 30 months. So that's what we're facing, and the economic impact has only just begun.
Well, we've been having some quite detailed conversations here in the office about what this actually means from a monetary point of view. So right. There's this debate, the inflation deflation debate, going on all over the shop. But I mean, who would have thought, in reaction to a virus, I mean, the amount of money that's been printed now is just insane. And there's just big consensus. I mean, we don't consensus with the mainstream over here, but among our editors in-house, the main view, it seems, is that at some point that money is going to make its way into assets and in the markets and cause a massive inflationary storm. Now, there's been a number of prominent investors worldwide that have switched from the deflation view to the inflationary. So I wanted to get your thoughts on where you think it is. Because I know by the very fact that you say we're in a depression suggests that you really think it's all about the deflation.
I do. Well, it's a great question. And you're right. This is the number one debate probably in the world of economics right now. But before we get into the debate or the discussion around your question, it's really, really important to define what we're talking about. I did an interview about a week ago, and it ended horribly. I don't even want to talk to the sponsor, but it was because I was paired off in a debate with well, leave the name out, but just say a guy who thinks if you shout louder, you win. In my view, the person who shouts louder is losing.
There's plenty of those in Australia as well.
putting that to one side. Now, the Austrian economists, and there are a lot of them out there, and others, they don't see any difference between price inflation and asset inflation. They say if you print money, it has to go somewhere, and you're either going to get higher prices or you're going to get higher asset values. And the more neo-Keynesian point of view, the more mainstream point of view, or I'll say for that matter, monetarist, Milton Friedman says, Now, you don't have to really talk about assets. Let's talk about prices. If you print more money, you're going to get higher prices. Both those views are incorrect. They're just not support. Now, in theory, yeah, you can have all the theories you want, but let's look at the real world. Let's look at data. There's no empirical support for that view. In 2008, the Federal Reserve balance sheet was approximately $800 billion. In 2014, when they ended QE3, it was $4.5 trillion. Okay, so they increased the money supply by a factor of 4 plus, and there was no inflation, none. So you can't tell me that printing money does not produce inflation. In terms of consumer prices, and I look at consumer prices, and the reason I do that, first of all, that's the widely accepted definition. Number two, that's what policymakers look at, and if your job is to anticipate policy and think about the impact on markets, if you're not using the same definitions as the policymakers, you're never going to get it right. So again, it's a nice abstract debate, but I define inflation as consumer prices, what you pay at the gas pump, what you pay in the supermarket, what you pay for a house for that matter, or rent, or anything else that goes into a lifestyle, goods or services. Now, if you want to include assets, that's different. And if you include both, it's like, well, yeah, I guess something's going to go up, but it sort of dilutes it to the point where it doesn't have much meaning. So I look at consumer prices, the prices that people actually pay to live. We are going to get deflation. And the reason has nothing to do with printing money. Printing money does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. And I can demonstrate it with some, I can do calculus, but I always say there aren't too many economic problems you can't solve with sixth grade math or sixth grade arithmetic for that matter. So take the following. Right now, the Fed has taken its balance sheet to $7 trillion, up from about $3.8 trillion at the start of the pandemic. So by the way, all that progress they made getting from $4.5 trillion down to $3.8 trillion, they're now up to $7 trillion. So it's all been reversed and they're probably on the way to 10 trillion. But do this math. 7 trillion times zero is what? It's zero. Yeah. Meaning it's the money supply times velocity equals nominal GDP. If you don't have velocity, you don't have an economy. 7 trillion times zero is zero. So the key to inflation, the key to nominal growth, and nominal growth in excess of capacity is inflation in terms of prices, is velocity. Velocity is the turnover of money. So I use the simple example. I'm at a bar, I'm leaving for the night, I tip the bartender. The bartender takes a taxi home and tips the taxi driver, and the taxi driver takes the tip and puts gas in his taxi. That money has velocity of 3. My $1 supported $3 of goods and services, the bar tip, the taxi tip, and the gasoline. But what if instead I stay home and watch TV, leave my money in the bank? My money has velocity of 0. In other words, I have the money, but it supports no goods and services. So velocity is the key, and the velocity is psychological, and that's what central banks don't understand. The Federal Reserve, but I dare say the Reserve Bank of Australia and others, they can stick the landing. They can make the money supply whatever they want, almost to 2 decimal places, but they can't change psychology. They can't change how you and I feel. And if we feel, prosperous, everything's coming up roses, going to go out and take our friends to dinner and we'll throw a party, whatever, then that's a certain amount of velocity. But if people are fearful, if they're engaged in what are called precautionary savings are savings where, according to your lifestyle or your business plan, you don't necessarily need to do it, but you do it because you're concerned about uncertainty. You're concerned about what comes next. So if your neighbor is unemployed, it's a good bet that your neighbor is saving like crazy, spending as little as possible because they need to pay the rent. But you have your job. Well, guess what? You're probably going to save more too because you don't know if you're next. What assurance do you have that you're not the next one to get laid off? And so you're going to save more. In the U.S., the savings rate had been going up from about 5% to about 8%, which is pretty high. In April, it went to 33%. And in May, it maintained a high level of 25%. That's the percentage of discretionary income that's going into savings, not you have to come 70% consumption. Well, if your consumption is savings, there goes your economy. So this is what you're up against. And all this stuff about pent-up demand, the V-shaped recovery, it's all nonsense. I mean, yeah, we're in a recovery. By the way, the technical recession, 2 consecutive quarters of declining GDP with rising unemployment, may already be over. Our referee here in the United States is the National Bureau of Economic Research, and they've said that a recession started in February, and I agree with that. So that was based on first quarter declining GDP. Second quarter GDP was down significantly. We're in the third quarter. We may be growing. So the recession may already be over, but the depression has years to run. And that's the difference. Just to use a metaphor, I fall into a 50-foot hole and I climb out 10 feet. Well, 10 feet, that's growth, but I still got 40 feet to go. And that's really the problem.
Well, you mentioned the psychology of people, and that's absolutely right. What we're finding in Australia, and I don't know if it's the same in the US, there is more trading and investor accounts opening than ever before. So there is something about that. So people are actually saving more, but they're also looking to put it in the stock market.
Right.
That's the next bubble. I don't know, because when the Fed or the central banks do something, it always triggers another action, and maybe this is it. I don't know.
Well, you're right. Well, you pivoted to asset values, which I don't consider inflation, but that's okay. A lot of people do. But let's talk about that. Let's talk about the stock market. People say, wait a second, Jim, you've given an extremely dire forecast of U.S. economic growth. You've described this as a depression, which I think is right, et cetera. But the stock market, our NASDAQ index is at new all-time highs. Yeah. Our S&P 500 index is at new all-time highs. Dow Jones is not quite there, but it's well on the way. So stocks are at or near all-time highs.
Jim, can I just say, Greg Canavan, our editorial director, he calls it the S&P 5. It's all down to 5 stocks, and that's it.
Well, that's right. That's a very good insight, because the S&P is what's called a cap-weighted index, meaning the larger your market capitalization, the bigger impact you have on the index. S&P 5, S&P 6, take your pick, but we know what those companies are. It's Amazon, Netflix, Apple, Microsoft, Google, and that's about it. And Facebook was the other one. And they comprise more than 30% of the S&P. So, and guess what? When they go up, what do people do? They buy them. When people buy them, what happens? They go up. When they go up, what else happens? They become a larger part of the index because the index is cap weighted. So what you're really seeing is the relentless rise of 5 or 6 stocks, which, by the way, have been relatively unaffected by COVID-19. Apple has some stores, a little bit of hardware there, but the rest of them are digital. They're streaming. They're online. They're things that people can do when they're home and are doing while they're home, work from home, etc. But meanwhile, what about the nail salons, the bars, the restaurants, the dry cleaners, the pizza parlors, the gas stations, etc.? And people call it small and medium-sized enterprise, fine. But guess what? It's 45% of U.S. GDP, and it's almost 50% of U.S. jobs. So, enjoy the stock market, bubble while it lasts. But don't mistake the stock market for the economy. The stock market has very little to do with the economy at this stage. They're very detached.
It's kind of a neat segue back to Trump and Biden and the US election coming, because, when for the first 3 years of Trump's presidency, he was kind of, pointing at the rise in the stock market as a sign of, oh, look how, and people, whether that's true or not, I don't know. But do you think this changes the outcome of that election? And also, I guess another question to it is, there's big talk about the remodeling capitalism in January at a meeting in Davos. Now, is that going to change depending on who wins too? Sorry, that's a big loaded question.
It's a compound question. That's okay. Let's just disaggregate it a little bit. First of all, why do you say Trump and Biden? Trump will be the Republican nominee. I doubt that Biden will be on the ticket in November. He may be.
You did actually say that in your weekly update that was published.
I personally doubt it. Sadly, and I think it's a shame that his wife and others haven't intervened, but sadly he is suffering from some not so early stage of dementia, Alzheimer's. I'm not a neurologist. I don't want to pretend to know medicine I don't know, and I haven't examined him personally, but from his public appearances on many, many occasions, not just one or two. And if you know anything about that disease, it's what we call a step function, which is you kind of plateau and then you drop and then you plateau and you drop. Now, you never go back up the steps. You go down, but you can kind of be okay for a while, or at least the same as you were, and then a sudden drop. Biden has had another sudden drop recently. They can't, you say, well, okay, what's the big deal? You get a friendly reporter, ask a scripted question, give a scripted answer on a teleprompter. What could go wrong? Well, the answer is he can't even do that. And he certainly can't debate Trump. And when I say can't debate, I'm not talking about, his wits or preparation or anything of the kind. I'm saying he just can't, he won't know where he is when he's on the stage. And so you have to push him aside. Now, the question is when. They will probably let him get the nomination. By the way, they've canceled the convention. The convention will be virtual. He'll try to, get through some scripted remarks. We'll see how he does. They'll probably name the vice presidential choice within a few days. I don't know who it'll be. The betting seems to be Kamala Harris, but we're not sure. We'll see who it is. But at that point, you have about 5 weeks between the convention and the first debate, which is scheduled for September 29th. They're going to have to do one of two things. They're going to have to replace him at the head of the ticket over the course of the month of September. But see, the advantage of picking the vice president first is that when it comes time to push Biden aside, the VP group will be the VP group. They're not going to be in contention. They're not going to say, oh, okay, Kamala Harris, you're the VP, so we'll make you the president. No, that's not going to happen. She'll be in the VP slot. President, take your pick. My guess is Andrew Cuomo, but the governor of New York. But Hillary Clinton's still waiting in the wings, and there are others as well. So get that done before the debates, and then go forward with the debates. The other strategy, much more dangerous, much more complicated, is to leave Biden at the head of the ticket, even though he's non-compos mentis, and then skip the debate, somehow cancel the debates. And the foundation for that has already been laid. Tom Friedman in the New York Times has said, well, you shouldn't debate Trump unless he releases his tax returns. Well, tell me what tax returns have to do with debates. But that kind of foundation has already been laid, and COVID-19 is sort of an excuse to do whatever it is you don't want to do, just blame it on COVID-19. So if he's the nominee, which we'll know actually in about 10 days, my expectation is he'll be replaced. But if I'm wrong about that, they will skip the debates, because the one thing they can't do is actually have the debates. And then you sort of go through the election, keep the guy in his basement, send out surrogates, do a lot of happy talk commercials, so for the best. If he wins, he'll be removed under the authority of the 25th Amendment to the United States Constitution, which provides for the removal of a president who is incapable of performing the duties of the office, at which point Kamala Harris would become acting president. If all this sounds crazy and scary and something like it's out of H.G. Wells, it's all happening. Democrats know it. They don't want to talk about it. It's kind of an open secret here in the United States. The only reason I mention it, I don't want to get into a long political digression, Woody, but Australian investors should understand that they and the world are in for some shocks.
Well, I mean, it has tremendous consequences. And the thing that I was going to bring in is that a lot depends on the relationship with China, especially Australia. So relations between China and America are deteriorating. They have been for a long time. There's that latest action that China's done in Hong Kong.
Right.
I mean, if Trump wins, that's just going to continue. What happens if he doesn't? I mean, that's where Australia comes into play a little bit, because obviously China's our key trading partner. The US is our biggest ally, and we're kind of in the middle of it.
Look, here's what's going on in China. First of all, they're extremely weak. Don't be fooled by the bluster and the bluffing and the wolf warrior diplomacy and all the rest. They're extremely weak, financially, militarily, and otherwise. Number two, what China is doing. I mean, they're doing. They have an organ transplant industry, but what they do, they take Uyghurs and Catholics and other political religious dissidents, and they remove their organs, kidney, spleen, lungs, etc., while they're still alive without anesthetic. And then they use that to feed a multi-billion-dollar organ transplant industry, and then they cremate the cremation at the end. They use concentration camps. And thought camps and what they call re-education, which is brainwashing, firing squads, on and on and on. They have ambitions. They're facing off against the Indians in the Himalayas, facing off against the Vietnamese and the Filipinos in the South China Sea, not too far from Australia. Last time I looked at the map, making some preparation for a possible invasion of Taiwan. So China is blustering, bullying, killing innocent people, democracy. Well, democracy was never the right word, but some freedom of speech, some rule of law that remained in Hong Kong is gone. Don't pretend it's otherwise. I'm not saying you do. I'm just saying that no one should pretend it's otherwise. The United States has unfinished business with China going back to the COVID-19. They had an outbreak and started, it's hard to pick a precise date, let's say late November, early December at the latest. By late December, their scientists were screaming, putting up posts on social media saying this is a new SARS, which it is. The COVID-19 is the disease, but SARS-CoV-2 is the virus. So it is a new form of SARS, the sixth coronavirus to jump from animals to humans. They knew it. They continued to allow hundreds of thousands of Chinese to board planes in Beijing, Shanghai, and Wuhan, for that matter, fly to the west coast of the United States and Milan, Italy, because it was Fashion Week and they own a big chunk of the Italian fashion industry. And it's almost as if they said, maybe they did say, hey, we've got it. Why don't we spread it to the rest of the world? Now, again, I'm not saying it was a bioweapon. I'm not saying it was released on purpose. I believe it was released on accident, by accident. I believe it did come from a laboratory. But that said, they could very well have seen it to their advantage to say, well, we got a problem. We'll give the rest of the world a problem. Be that as it may, they were, at best, they were criminally negligent. At worst, this is a crime against humanity. By the way, to their credit, Australia and the U.S. have always been staunch allies, and Australia is working with the United States in what we call the Indo-Pacific. We're no longer just a Pacific power. We're saying Indian Ocean Pacific power. And of course, there's a little bit of an emerging trilateral alliance among India, Australia, and the United States. All good stuff, good allies. And I'm well aware of Australia's dependence on Chinese basically buying exports from Australia. But the Chinese have suggested that they may look elsewhere, and Australia may have to look elsewhere for customers. It doesn't mean world growth comes to an end, but it does mean that supply chains get restructured and reoriented. So the United States, we've already commenced lawsuits. So the idea would be in the United States judicial system, you would sue Chinese entities for damages for criminally negligent handling of the COVID virus. The US, Australia, Europe, great scientists from France and Germany and the UK, they were waiting to get on planes, go to China at their own risk, deal with the virus, deal with treatments, get a head start on vaccines if possible, spend money, do whatever they needed to help the Chinese. The Chinese refused the help, denied the extent of the problem, and spread it around the world. So that's criminally negligent. So let's say you get damages in the US court. What would the damages be? Well, based on stock market activity and lost economic output, you're in the $4 or $5 trillion category easily. So you get a court judgment to that effect. People go, well, how are you going to collect? Well, I'll tell you how you're going to collect. China owns $1.4 trillion of US Treasury securities. The last paper security the United States government issued was in about 1980. Those securities are digital. They're kept on a digital ledger maintained by the Federal Reserve and the United States Treasury. One phone call from the president, they can be frozen or transferred. So if you have a winning lawsuit, you set up a trust for the benefit of victims of Chinese criminal negligence. You seize the 1.4 trillion and put it into the trust, and that money is dispersed for the benefit of victims. All perfectly legal. This is not some rogue default or anything of the kind. It's all, you get due process of law, but you lose. That's the kind of unfinished business U.S. has with China. If Trump wins, I would expect to see those things play out.
Yeah, right. That's pretty fascinating. So I got to ask you, we've gone about half an hour, so I don't want to keep you too much of your beach time. I can't have a conversation with you and ask you about the gold price. So in the last week, I mean, this all plays into the gold price too,
sure.
and the wider trend in gold. The last week, it hit an absolute historic all-time high, breached $2,000 US. Why do you think that is happening right now? Do you think it's just the unstableness of the world, or is there something deeper going on?
Well, when I see the dollar price of gold go up, I say to myself, this has nothing to do with gold and everything to do with the dollar. In other words, you can say, oh, gold went from $1,900 an ounce, which was the all-time high, to 1950 to 1975, 2000. Today, it's around 2030, up and down with some volatility. You can say gold's going up, up, up. And I say, no, the dollar's going down, down, down. That in other words, if it used to take $1,000 to buy an ounce of gold, which it did on December 16, 2015, today it takes over $2,000 to buy the same ounce of gold. The ounce of gold is unchanged. It looks the same. Atomic number 79 hasn't changed a bit. What has changed is the dollar has lost half its value in the last 5 years. That's going to continue. And so when we talked earlier about inflation, deflation, asset prices, just look at the dollar price of gold. There's your dollar devaluation. There's your loss of confidence. There's your dollar collapse. You don't see it against the euro. All these currency traders are looking at DXY, the Bloomberg index, or the Fed has a broad, real trade-weighted index. They're all, it's all good data. But that's not where you'll see the collapse of the dollar, because that's currency to currency, and they're all in the same lifeboat. You'll see the collapse of the dollar against gold, and you're seeing it right now. So I expect gold to go to $15,000 an ounce by maybe 2024, if not sooner. That's just based on a simple average of the last two bull markets, 1971 to 1980 and 1999 to 2011. You don't even have to pick the higher of the two. Just take a simple average, and that's what you get. There's more to the analysis, but gold is going much, much higher. So if you've missed the move from 1,000 to 2,000, as you know, Woody, I recommended it at 1,100, 1,200, 1,300, 1,400, 1,500, 1,600, 1,700. You get tired of talking about it. 1,800, 1,900. It's over 2,000. You haven't missed the big move. The big move is still ahead. When you look at these bull markets, they start out at a certain tempo, and gold's up over 100% in the last 5 years. But in the first bull market, started in 1971, it went up over 2,000%. And the second bull market, starting in 1999, it went up almost 700%. So we still have a long way to go.
And finally, you got your new book out, which is due out in October the 27th, correct, I believe.
Correct.
We're going to hopefully you give me your contact at Penguin, so we're going to get a load of books in for our readers so that they can have a good read of it. Is there a glimpse in there that you can tell us? You obviously you cover the pandemic and you cover the consequences, financial and otherwise, in that book. What about gold stocks?
Yeah, they're in chapter 6. Gold stocks are in chapter 6. First of all, this will be the first book on the COVID pandemic. We started writing it in May, finished it by mid-June. This is all lightning speed. I usually take 18 months to write a book. This one took about 6 weeks, but we didn't cut any corners. Just had to work that much harder. It'll be out in bookstores and Audible and elsewhere. And you guys will get, by the way, thank you for your interest in the book. You'll get it in advance of other outlets through my publisher. It's the first book on COVID and the Depression, and looks at the expected failure of monetary policy and fiscal policy. And finally, there's a chapter, because my editor says, Jim, you can't just write doom and gloom. You have to give readers some cause for hope.
I really love doom and gloom. Deep down.
Well, to an extent, but at the end of the day, they say, well, okay, what do I do with my money? But there's a whole chapter on that. It covers a number of asset categories, but has a big section on gold. And yes, gold, physical bullion, and gold mining stocks are a big part of it. And it's all described in detail in the book in chapter 6.
Well, I can't wait to bring it to our readers, Jim. Thanks for your time.
Thanks, Woody.